Welcome back, everyone. Today on the Joseph Carlson Show, the S&P 500 is off to a great start in the year, and it's recently just hit a rough patch, and we're headed back down. And it feels like we're right back in 2022. The market is still difficult, and that is the theme of today's episode. The stock market is difficult, and it's not getting easier. This is something that Howard Marks just went on to Bloomberg, and he explained what he called a sea change, a profound and fundamental change in the way that investors have to think about investing, because investing is no longer easy. So we're going to be going over the sea change and what we can do with our portfolios to better prepare for the likely future ahead of us. Now, we also have some unfortunate news. Layoffs are never fun, and big tech is announcing a lot of them. Microsoft announced 10,000 workers are going to be laid off. And this comes right after Amazon announced that 18,000 workers are going to be laid off. 30,000 employees between just two companies. And there seems to be more layoffs every single day. And then lastly, we have some amazing news here. This Disney executive, he made $8 million in less than 4 months of work. We'll be going into this story, what this executive did to earn this money, and the broader theme of executives' pay. Executives are finally starting to take lower and lower compensation. So as always, we have a lot to get to in this episode. Let's go ahead and jump in right after a quick message from today's sponsor. The sponsor of today's video is M1 Finance. I started using M1 Finance literally 5 years ago, back in 2017. I uploaded my first YouTube video in 2019. So I've been using this platform for years, even before ever doing YouTube. The reason that I've been using M1 Finance for so long is because I love their products. M1 Finance offers an ecosystem of tools to manage your wealth. We have M1 Invest here, which I use for my dividend growth portfolio. M1 also allows you to use margin, and their margin rate is one of the lowest in the industry. I'm able to borrow over $140,000 based off my passive income portfolio. M1 also has a checking account where I keep my emergency savings. And coming soon, M1 Finance is offering a high yield savings account with a 4.5% annual percentage yield available to M1 Plus members. And the best part is both the checking account and the saving account are FDIC insured. So if you haven't already, try out M1 Finance right now. They're offering both rewards for new signups and transfers of accounts based on the amount that you're transferring. Go ahead and sign up using the link in the description below. Now let's go ahead and get started. If you're new to the channel, this is my personal portfolio. I share it every single week on YouTube with complete transparency. So far this year, it's up 2.86%. It's come down a little bit as the market's traded down. Now, in this portfolio, I focus on buying high quality compounding companies that I think are very resilient. They have financial characteristics that are much better than the average company. They have high margins, high profitability ratios. They have low leverage. They have low amounts of cyclicality. These are true compounders. They're companies that are monopolistic or oligopolies. They're highly entrenched in the markets they compete in. And I've been building up position in company after company that meet these very high standards. I'm investing in companies that have very predictable and reliable growth. So when I look at my portfolio overall, even though most investors are concerned by the day-to-day swings of the market, and most investors get very excited when the market goes up, and they become very discouraged and sad when the market comes down, we don't do that at the Joseph Carlson Show. We don't get excited when the market goes up, and we don't become sad when the market goes down. We keep investing in compounding companies and let these companies grow their free cash flows and earnings. Now, what's happened this year so far has been pretty interesting. The market has raced up towards the beginning of this year, and investors were feeling good. This lifted investors' spirits. It was a new year, 2023, and we were already up 5%. Then the market did what it has done before. It went right back down 2.5%, giving up the majority of gains this year. And that's where the predictions of Howard Marks come into play. Howard Marks is the founder of Oaktree Capital, and he's known for his extensive memos. He recently came out and said that what he believes is happening right now is called a sea change, a profound and notable change in the investing fundamentals. And what Howard Marks starts off with is how investing used to be from 2009 to 2020.
These things produced what I would call was an easy environment in the economy and the markets. We had the longest economic recovery in history. It was easy to make money. Right. We had low-cost capital. It was easy to make a profit. We had very few defaults in bankruptcy. It was easy to stay in business. It was easy to access capital. Everything was easy at that time.
The entire setup was easy for investors, and the results show that to be the case. Look at the stock chart of the S&P 500 from 2009 to 2020. It's basically a money printer. Every single year, just more and more gains. You didn't really have to time the market. You could just buy in at any point, and soon enough, you'd be in the green. And if you just held through some minor volatility, you would continue to make money. From 2009 to 2020 could only be described as easy. Everything in terms of investing, the entire atmosphere was made easy for investors. For the majority of this time, interest rates were rock bottom. They went down to basically nothing. The cost of capital, the cost of taking out debt was incredibly low. The Fed was also an ally of the market. Their balance sheet grew substantially as they're doing quantitative easing, making things easy for the investor. And this is the big fundamental shift that Howard Marks is pointing out that many investors still don't realize. Things were not only easy during that time period, they were unnaturally easy.
Everything was easy at that time. And in the last year, of course, with the appearance of the inflation and the increasing of rates to try to stamp out the inflation, things have gotten harder. I imagine people today saying, well, when are we going back to normal, like it was 5, 6, 7 years ago? And the important thing to know is that that wasn't normal.
Right.
That was the easiest, the best of times.
Right.
And my own belief is we're not going back there. We're now in an environment of more normal circumstances, and we're going to roughly stay this way.
We're not going back to the way things were in the prior decade. And the investors that are still thinking back to the good times, still holding on to hope that we just have to suffer through some minor volatility until the market starts racing back like the way it was, they're mistaken, and they're not paying attention to the sea change, to the profound fundamental change that's already taken place in the market. This special time period between 2009 and 2020 wasn't only easy, but it was unusual, and it's unlikely to be repeated. We are unlikely to go back to this time period. And unfortunately, when I look at the demographics of my channel, when I look at the actual people viewing this information, the majority of you are in an age where that's really the only time period that we know. Most of us started investing after 2009. And I think the big problem that I see with so many investment portfolios is they're gauged around a time period that's unlikely to be repeated. And the market has taught a lot of very bad lessons over the past couple of years. One of the bad lessons that the market's taught us over the past couple of years is that it's a legitimate business model to sell something for less than the cost of making it. Uber is a perfect example of this. This company is the quintessential company that sells something for less than the cost of making it. Anytime a company does this business model of taking a product, marking it down, losing money on every sale, of course they grow revenue. That's common in all of them. Uber grew its revenue, but what it doesn't have is any type of profits. No EBITDA, no free cash flow, and no earnings. This company is unprofitable. These were the type of companies that investors flocked to over the past 5 years, with high amounts of liquidity and with an easy investing environment. But that was a wrong lesson that we learned. In reality, selling something for less than the cost of making it is not a legitimate business model. And hoping that the company can turn a profit someday down the road is not a legitimate investing strategy. Companies like Uber are not going to give investors good returns. Fubo's another company that does this. It sells a product for less than the cost of making it. That's why it has explosive revenue growth. It's great that they're taking in lots of revenue, but they're not actually making any money. And this is where the market taught us a lot of bad lessons, that these companies were worth a lot of money because someday down the road they'd turn a profit. And in the meantime, they can just scale and scale and scale. Look at the price this company went up to. $60 per share. And it's no longer at $60 a share, it currently trades at less than $2 a share. Selling a product or service for less than the cost of making it is not a legitimate business strategy. The go-to excuse for buying unprofitable companies is Amazon. This is the go-to example of a company that's been unprofitable for decade after decade, but has still given investors great returns. Now, it is true that Amazon has given phenomenal returns over the past 20 years, but where investors get this wrong is that Amazon has actually been free cash flow positive. It's been profitable for over 20 years, since almost the very beginning. After 2001, every single year up until 2021 has been free cash flow positive. So ironically, as investors cite Amazon as the go-to excuse for buying unprofitable companies, they're citing a company that has been profitable for 20 years straight. All of big tech has been highly profitable for a long period of time. Microsoft's profits go all the way back to 1989. Google was highly profitable right from the beginning. From 2002, the company was printing cash and it scaled its business while being profitable. Apple has been a highly profitable company ever since 2004. Ever since then, it was off to the races. Good companies make profits, and they usually make them right from the start. Bad companies are ones that always promise profits in the future, they dilute shareholders, and they never generate any amounts of meaningful profits. So we need to update our thought process. A lot of the lessons we've learned over the past 5 to 10 years have been very bad lessons. Unprofitable companies are not good companies. They're not good investments. And if they are good investments, you can simply wait until they become profitable. Part of the reason that my portfolio has held up relatively well during this massive sell-off is because I'm only focusing on highly profitable companies that have high margins and high returns on capital employed. And of course, the problem is during this time period that all these bad lessons were taught, many investors are still anchored during that time period. They still have their thoughts and their investing strategy centered around a time period that doesn't exist anymore. But this change has already happened, and investors that don't update their thought process are going to get hurt.
Right. Well, that's what a sea change is. It's a complete transformation, not just a minor cyclical fluctuation. So, look, I think that the business world, the economic world, is not supposed to be easy. It's not supposed to be easy to make money.
Right.
Or, it's not supposed to be easy for companies with bad business models to stay in business, as it has been for the last 14 years.
Right.
So I think we go back to a period in which we have moderate interest rates, we have moderate availability of capital, we have a moderate default rate, and so forth, all of which will feel much less accommodative, I think, than the last 14 years.
Saying that things will feel much less accommodating over the upcoming years is financial jargon for saying that investing is going to get much harder. The reason I'm taking these warnings so seriously is because I think that Howard Marks is accurate. I think this is a sea change that's already happened, and whether investors want to admit it or not, the environment that we're going into is much more normalized, much more difficult than what we had over the past decade. And I think that if investors still try to employ the same crummy investment strategy they did before, it's simply not going to work. Investors that are focusing on companies with incredibly weak fundamentals that try to bolster their stock price through various tricks, it's simply not going to work. Another bad lesson that the past 10 years have taught us is that stock-based compensation really isn't money. It's fake money. It doesn't really count. You have a company like Uber, for example, that it posted a couple quarters of positive free cash flow. That's really great. The company's actually making money right now. Well, not really. If you factor in stock-based compensation, this is what the chart looks like. Even today, the company's still not profitable, unless, of course, you treat stock like it's not real money. This $482 million they paid their employees, that's just monopoly money, right? Well, that's the way these companies want you to view it. They try to hide this from their report. They try to pretend like this isn't real money. And this is something that is a bad lesson of the past. And many investors are still believing this nonsense. The companies that I'm investing in are ones that generate real profits even when you factor in stock-based comp. I think the strategy that investors should employ is hope for the best but prepare for the worst. And unfortunately, what a lot of investors are doing right now is hoping for the best and preparing for the best.
Rates are roughly where they can stay, except that I think it's important to recognize that the debate today is being dominated by people who are optimistic, by people who think that the recession won't be too bad, won't be too long, that the inflation will give way, and that the Fed will be able to turn accommodative soonish.
Are you optimistic?
Not on that subject.
Sitting around with a portfolio full of bad business models, bad companies that are highly dilutive and unprofitable, and then hoping that the Fed will turn around and that the Fed will become accommodative and that the Fed will bail out your portfolio is not a legitimate investing strategy. I've been calling this out for over a year, and I'll continue to call it out. Investors that continue down this path are going to continue to get hurt. And these little bumps of hope once in a while, these little mini rallies along the way, they're not going to be sustained because fundamentally a bad business model is a bad business model. I compile different watch lists of companies that I think meet certain criteria for investment: high profitability, organic growth, low amounts of stock-based compensation, good pricing power, world-class companies that I think will do well over the next 10 years. And one of the things I notice when I go through different companies is how many of them are built upon unsustainable business practices that are entirely reliant on low interest rates. Some companies have to pay for growth so aggressively that they spend nearly all of their revenue on growth. Monday.com, for example, a company that's basically a task manager or to-do list for different teams. This company did $308 million in revenue in 2021. $308 million. This company spent over that same year $268 million on marketing and sales. 268 out of 308. That means that this company spent 87% of their total revenue on marketing and sales in that entire year. It's reliant on an aggressive sales team to grow the company at all. There's no organic growth. And there are so many companies in the market with very poor business models that are being exposed. Their stock prices are getting crushed. Investors are learning hard lessons that they don't have to learn through experience. So I'm not going to tell you how to form your own portfolio or what investments to make. Your investment decisions are your own. But I can share with you what I'm doing with my investments. I think the economy is slowing down. The Fed is pushing the brakes on the economy hard. With an economic slowdown, it's more difficult to find companies that can actually turn a profit. And finding companies that turn a profit will become prized possessions. Companies that are actually highly profitable will become more value relative to all the swaths of companies that get exposed for being the bad companies that they are. So when I look at the probabilities of the future and see that things are slowing down, I'm tightening up my portfolio into companies that I think can turn out earnings growth and free cash flow growth consistently over the next 10 years. Some companies that I've highlighted before that are recent purchases of mine are two of them in the financial category. I bought into S&P Global and MasterCard. Now, I can't say whether I bought the absolute low on these companies. They might dip down further than what they already are. But I feel very good about these purchases for very specific reasons. Between MasterCard and Visa, they form an oligopoly of payment rails. They're highly entrenched businesses, unlikely to be disrupted. And even though these companies are incredibly high quality, monopolistic, and have long-term pricing power, they trade at a 28 forward PE. MasterCard's expected to grow earnings at a rate of 15% for the next 3 years. And when I do analysis on this company, I strongly believe it'll be able to grow its free cash flow per share at a mid-teens rate for the next decade. It's already done so for the past 10 years, and I see no reason it won't be able to do so for the next 10 years. S&P Global is another company that I think matches a lot of these qualities. It has a decades-long runway of pricing power, organic growth, low capital intensity, and I think that it looks artificially expensive right now because of its trailing metrics. The free cash flow yield over the trailing 12 months is only 2%, which makes the company seem a little expensive. But when I actually average out the free cash flow yield over the past 3 years, I see a company that's much cheaper than what it looks like right now. So I think this company is much cheaper than it looks on paper. In the meantime, it is a high quality compounder with incredibly good pricing power, a long runway of growth, and another company that I believe can grow its free cash flow per share at a rate above 10% for the next decade. So my view is, even though investing has gotten more difficult and the future looks like a tougher road ahead than the previous decade, I think it actually is a time of opportunity, a time where companies are separated good from the bad. Good companies will get rewarded, bad companies will get further punished. The investors that continue to buy bad companies, ones that are unprofitable with highly dilutive business models, poor cost structures, high marketing costs, and inorganic growth, all I can say is best of luck, because I think you'll need it. Now moving on, we have some news that's always unfortunate, sometimes necessary, but always unfortunate to hear, which is people are losing their jobs. We have layoffs being announced by Microsoft. 10,000 so far, and my prediction is this number will go up over time. In the case of Microsoft, the software executive's chief executive, Satya Nadella, wrote that the layoffs would happen before the end of March and affect less than 5% of the company worldwide. So 10,000 is a massive number, but then they cite a small percentage, 5% of the company. When we put that into perspective, this is what it looks like. From 2021 to 2022, Microsoft added 40,000 employees. And looking at it from this perspective, it doesn't seem quite as severe. But in total numbers, 10,000 is still a ton of people. In a blog post to employees, Mr. Nadella pointed out the shaky economy, telling employees that companies globally have begun, quote, to exercise caution as some parts of the world are in recession. He added that the company would be taking a $1.2 billion charge in its soon-to-be announced earnings related to severance costs. So just laying off all of these employees is actually an expensive endeavor to do for a company like Microsoft. And the real truth here is that these companies simply overhired. That's the bottom line. They projected out too much future growth, and now they're starting to trim back. There's other companies that haven't really been acting all that prudent recently. We have Disney as an example here. Disney had an executive that worked at their company for less than 4 months and took in $8 million in compensation, or about $119,505 per day, according to the calculations based on a proxy statement that Disney filed Tuesday. And that's not even all of it. When the payouts associated with this termination agreement are taken into account, that per day figure jumps to $176,000 per day. Disney also paid Morel about $500,000 to move his family to Los Angeles from London and another $500,000 to move away when he lost his job. So another $1 million in moving expenses. Now, I don't know about you, but I've moved locations a couple times throughout my life, and I don't remember it costing $500,000. I think it was a little bit cheaper. Is it really that expensive to fly from Los Angeles to London? I know plane tickets have gone up, but $500,000 to move one way and then $500,000 to move back seems a little high to me. Now, of course, after he left the company, Disney bought the $4.5 million Southern California home that Mr. Morel had purchased, according to the Disney filings. So apparently Disney's in the real estate business of buying private residential homes of their executives. When the board members move back home and they get fired, Disney will pay $4.5 million for their home. It's actually breathtaking how self-serving some companies are with their executives and their compensation packages. And I'm personally glad that there's some investors that will try to step in and be a strong, scrutinizing, critical force on the board. I hope that Nelson Peltz does get his board seat. I know a lot of you are confused of why I still hold Disney, why I have it in my portfolio. Right now, I think the company, even with the mistakes the leadership and board is making, has such incredibly valuable assets. So even though the management is not managing the company in a way that I would want, I still think the company's undervalued relative to its future outlook. That's all for now. I'll see you in the next one.